The Road to Success, Fundamental, Technical, or Mental Analysis. This is an original educational explanation not copied from the book, written as detailed study notes. It covers the full lesson, why most traders fail, what analysis really means, and why mental analysis is the true foundation of consistent success. Chapter 1: The Road to Success. Fundamental, Technical, or Mental Analysis. Introduction: The central question of trading success. Every trader, at some point, asks, what do I need to master to become consistently profitable? Most answers fall into two categories. Learn better fundamental analysis. Learn better technical analysis. Mark Douglas introduces a third, far more important dimension: mental analysis, mastering your own mind. This chapter explains why thousands of intelligent traders with good systems still fail, while a small group with average strategies succeed consistently. The difference is not intelligence. It is not information. It is not prediction skill. It is psychological discipline. Part 1: The Early Belief. Fundamental analysis is the key. What is fundamental analysis? Fundamental analysis attempts to predict price using company earnings, economic data, interest rates, inflation, news, supply and demand reports, political events. The belief: if I understand what is really happening in the world and in companies, I can predict price. Why new traders start here? Beginners assume markets move logically. Prices reflect real value. Good information leads to good trades. This feels reasonable because in normal life, knowledge, better decisions, better results. But markets are not normal environments. The problem with fundamental analysis in trading: information is incomplete. You never have all the data. Other traders may know something you don't. Interpretation differs. Two experts read the same data and reach opposite conclusions. Timing is unpredictable. Even if you are right long term, price may move against you short term. The market reacts to expectations, not facts. Price often moves before news is released. Psychological consequence: when fundamental traders lose, they think the market is irrational. This move makes no sense. They begin to fight the market emotionally. Part 2: The Shift to Technical Analysis. After losses, traders say, fundamentals don't work. I need charts. What is technical analysis? Using price patterns, indicators, support or resistance, trends, candlesticks, volume, statistical models. The belief: price contains all information, patterns repeat. Why technical analysis feels better. Visual, structured, objective, immediate feedback. Looks scientific. Many traders finally feel, now I have control. But the same problem appears again. Even with good technical setups, losses still happen. Drawdowns occur. Streaks of losing trades appear. Emotions arise. So traders start hesitating, overtrading, moving stops, closing winners early, holding losers, revenge trading. The system didn't fail. The trader's mind failed. Part 3: The Hidden Enemy, the Trader's Own Mind. Mark Douglas states clearly, the market does not cause your emotional pain. Your beliefs do. Why trading is psychologically unique. In normal life, effort equals reward. Skill equals success. Rules are stable. Outcomes are mostly predictable. In trading, effort does not guarantee profit. Being right does not guarantee winning. Randomness dominates. You are constantly uncertain. You are personally responsible for losses. This environment is unnatural to the human brain. The core conflict: human mind seeks certainty, safety, control, consistency, validation. Markets provide uncertainty, risk, random distribution, no guarantees, no fairness. This conflict creates fear. Part 4: Why smart people fail at trading. Many traders are engineers, doctors, accountants, programmers, analysts, highly intelligent, yet they still fail. Why? Because trading does not reward intelligence alone. It rewards emotional neutrality, risk acceptance, discipline, probability thinking, consistency, the illusion of control. Traders think, if I analyze enough, I can control outcomes. But you cannot control market direction, news, other traders, random order flow. You can only control your entries, your exits, your risk, your mindset. Part 5: The Real Definition of Success in Trading. Most traders define success as winning trades, Professionals define success as following my rules perfectly, because perfect execution over many trades profits, emotional decisions inconsistency. Part 6 Mental Analysis, the missing skill. Mental analysis means understanding your fears, understanding your beliefs, understanding your emotional reactions, training yourself to think in probabilities, accepting uncertainty completely. Key psychological skills of successful traders. Accepting risk fully. No emotional attachment to outcomes. No need to be right. Complete responsibility. Consistency over excitement. Thinking in series, not individual trades. Part 7 Why losses hurt so much. Losses hurt not because of money. They hurt because they threaten self-image. They trigger fear of failure. They activate survival instincts. They feel like personal rejection. The mind says, I am wrong. I am incompetent. Professionals do not connect self-worth to trade outcomes. Part 8 The Trader's Paradox. To succeed you must care deeply about execution. Care very little about individual outcomes. This is unnatural. Part 9 Probability thinking versus prediction thinking. Amateurs think, this trade will win. Professionals think, this setup has a statistical edge over many trades. Like a casino, individual results irrelevant. Long-term edge matters. Part 10 The Roadmap to Trading Success. Mark Douglas outlines the real progression. Stage 1 Learning Analysis Fundamental Technical. Necessary but insufficient. Stage 2 Experiencing emotional pain. Losses reveal psychological weaknesses. Stage 3 Understanding Mindset Importance. Trader realizes, the problem is me, not the market. Stage 4 Mental Training. Developing discipline, acceptance, consistency. Stage 5 Professional Thinking. Trading becomes boring, calm, rule-based. Part 11 Why most traders quit here. Mental training is slow, uncomfortable, requires self-honesty, requires ego death, requires accepting uncertainty. Most people prefer new indicators, new strategies, new gurus, instead of fixing themselves. Part 12 The Central Truth of Chapter 1. Trading success is 80% psychological and 20% technical. Without mental mastery, best strategy fails. Best analysis collapses. Best indicators become useless. Part 13 Practical Lessons from Chapter 1. 1. Stop searching for the perfect system. It doesn't exist. 2. Accept uncertainty as permanent, not temporary. 3. Detach self-worth from results. You are not your last trade. 4. Measure success by discipline, not money. Money follows discipline. 5. Train your mind deliberately, as seriously as technical skills. Part 14 Simple Summary. Fundamental analysis asks, what should happen? Technical analysis asks, what is happening? Mental analysis asks, how do I react to what happens? The third determines everything. Final conclusion. Mark Douglas's message in Chapter 1. You do not fail at trading because you are stupid. You lack information. You lack talent. You fail because you think like a normal human in an abnormal environment. To succeed, you must build a trader's mind. Calm, disciplined, probability-focused, emotionally neutral, risk-accepting. That is the real road to success.